Have you ever stopped to wonder how an entire country keeps track of every single dollar, euro, or yen that flows across its borders? Well, we're about to open up the books on a nation's global finances to see exactly how it's done.
I mean, it sounds almost impossibly complex, right? We're talking about everything from a massive shipment of cars to a foreign company buying a local startup to the aid one government sends another. How do you track all of that? It turns out there's a powerful accounting tool for this, and it's called the balance of payments.
So, here's how we're going to tackle this. We're going to build our understanding from the ground up, piece by piece. We'll start with the basic rules of the game, then look at trade, add in transfers, cover all the investment stuff, and finally see how it all magically balances out in the end.
All right, let's dive right in. What exactly is this balance of payments? To get it, we have to start with the fundamental rules.
The easiest way to think about this is like a country's annual financial statement, but for its dealings with the entire world. The key thing here is that it tracks every single transaction that involves foreign currency crossing its borders.
Now, this is the single most important rule to remember. Seriously, everything else builds on this. If foreign money comes into your country, it's a credit. It's money in. If your country's money goes out to pay for something foreign, it's a debit. Money out. It's that simple.
Okay, so let's put that rule to work with our first building block, the one you probably hear about all the time, buying and selling actual stuff.
This is the part of the balance of payments that makes the news, the trade balance. It's just tracking the physical goods and, the intangible services like tourism or consulting that a country sells to the world versus what it buys from the world.
So let's look at it on a ledger. When a country exports something, what happens? Foreign currency flows in to pay for it. That's a credit. And when it imports something, its own currency has to flow out to pay for it. That's a debit. This first section of our checkbook is the trade balance.
But of course, trade isn't the only reason money moves between countries, so let's add the next layer to our picture. You see, sometimes money just flows in one direction, kind of like a gift, without any goods or services being exchanged in return. Think about foreign aid, or maybe a grant from another country. These are called unilateral transfers. And when we add these one-way payments to the trade balance, we get a bigger, more complete picture called the current account.
Let's use a real-world example. For Israel, the aid it receives from the U.S. means billions of dollars are flowing into the country each year. So on Israel's balance of payments, that's a credit. Now, from the U.S. perspective, since the money is flowing out, it would be recorded as a debit.
So looking at our growing ledger here, we can just add a new row right under the trade balance for these transfers. Aid received is a credit, aid given is a debit. Add those two rows together and voila, you have the current account. We're starting to get a much clearer picture now.
All right, we've covered goods, services, and gifts. Now it's time to talk about the really big money flows, investments, loans, and assets.
This is where the capital account comes in. Sometimes it's also called the financial account. It tracks all the financial flows that aren't for day-to-day trade. We're talking about buying and selling major assets, things like entire companies, office buildings, or government bonds.
Okay, let's make this really concrete. Remember when a foreign company bought the Israeli tech firm Mobileye? A massive amount of foreign currency flowed into Israel to make that happen. That's a huge credit. But on the flip side, if an Israeli investor buys a building in New York, money has to flow out of Israel to complete the purchase. That's a debit.
So now we can put it all together. Here's our ledger. We've got the current account, which we already built, and right below it, we add the capital account to track all those big investment flows. Together, these two accounts capture pretty much every single international transaction a country makes.
So we've built all the components. We have money coming in, money going out, but how does it all resolve into a single balanced statement?
Well, here's the magic of it. It's the fundamental law of accounting. And it doesn't just apply to businesses. It applies to entire countries, too. The total amount of foreign currency coming in, all those credits, has to equal the total amount of currency going out, all those debits. It always balances.
But wait, you're probably thinking, what happens if a country actually spends more foreign currency than it takes in? How can the books possibly balance then? Well, the answer is in the country's national savings account of foreign money, its official reserves. If there's a shortfall, the country can dip into those reserves to make up the difference. And if it takes in more than it spends, its reserves grow. That change in reserves is the final entry that makes everything perfectly balanced to zero. And that leaves us with one last, really important question. If the balance of payments as a whole always balances, what does it truly mean when we hear on the news that a country has a massive trade deficit? If the whole checkbook is balanced, what part of the story are we missing?